RBI last week hiked interest rates by 50 bps, thus taking the repo rate trajectory to 5.9%. The central bank has been directing banks to pass on the benefit to its customers, but the progress has been very slow on this front. On the contrary, home loan rates are inching up at a greater speed. Therefore, what is your real rate return? How should you manage your money going ahead? To discuss all this on the show, we have now Roongta, founder, Fee Only Investment Advisor, LLP. Harsh, good evening. Welcome to the show. Before I slip into the further interest rate hikes discussion in terms of raising deposit rates and also the home loan rates, I want you to help us understand the real return benefit from these rate hikes an investor would get if at all they are investing in a fixed income instrument right now.
So, if you are a new investor, that is, you're putting new money into investments and you want to sort of put it in a safe fixed income security, I think the first thing that comes to your mind is bank fixed deposits. Assuming you have this money for a fairly medium to long term, say maybe 5 to 10 years, you would want to sort of lock in, because once you put it in, after that the interest rates will not change. So you might want to do a little bit of timing on that one, and maybe wait a little in terms of the deposit rates to catch up with the general increase in interest rates. Another good way could be to sort of go for what are called the target maturity funds. Just to simplify, like you have this fund of funds called Bharat Bond, let's say 2031. Now, that has the bonds of various PSUs that will mature in April of 2031. Currently, that would have an yield of roughly in excess of 7.5%. So if you put in the money today in that fund and hold on till 2031, you have a great probability of making more than 7.5% on a gross basis. And because it is tax advantaged, you will, on even net of tax, you will make far higher than what you would on a fixed deposit. You can withdraw the money beforehand, but in that case, you would sort of might lose a little bit if interest rates have gone up in the meantime.
So all the benefit right now, Harsh, would be for depositors who are parking in money now, not for the existing ones. And over here, I also want you to help us understand the interest rate hikes in 3 of the small savings schemes, which after 4 years, they are welcoming. Of course, it feels good, but are they really enough?
So I think a little bit of a background on this interest rate of small savings might be in order, because in theory and on paper, the small savings rates are required to be reset every quarter, and they are linked to the government securities rate of an appropriate tenure. So, on paper, it is supposed to be the average rates of that government securities of that tenure, plus plus a small spread, and that becomes the rate of a particular instrument, let us say senior citizen savings scheme. Now, the issue with that has been that in the past, both when rates increased and when rates decreased, this rule has not been followed. I think all of us will remember the circular that was issued reducing the rates, and it was then withdrawn within, within a day or so, because it was just before state elections in West Bengal. So I think this has been, the rates didn't fall when, the rates of small saving instruments didn't fall when the general interest rates fell post the COVID pandemic. And now, therefore, the increase has also happened with a lag, and I don't think it will capture the full lag. So You have, for example, senior citizen going up by about 0.2%. Interest rates, please remember, had risen from, you know, it has risen by about 1.9% in the last 14 or 15 months. The time deposits have also been increased. So I think we are going to see a little bit of this interest rates not really following the trajectory that they are supposed to follow. They didn't follow them down. They are not going to follow it completely up.
Harsh, one concern, because rates are still unchanged for PPF and Sukanya Samriddhi Yojana, which are the most popular and the most investor-friendly and known investment instruments. Do you think further going on, there'll be some change over here, some increment coming over here on these schemes as well? Should one wait?
So, I mean, as far as say Public Provident Fund and Sukanya Samruddhi is concerned, waiting makes no sense. If the rate goes up, that the rate that the new rate will become applicable from that day onwards for any money that you have invested. So I don't think there is any reason to wait if you have made up your mind to go for a Public Provident Fund and a Sukanya Samruddhi. So suppose you put in 1 lakh today, you will obviously in Sukanya Samruddhi get 7.6. But let us say 6 months down the line, the rate gets increased to 7.8. Then from that day onwards, on that account, on that 1 lakh, you will get the increased rate. Conversely, if the rate goes down, you will also get a reduced interest rate. So it's already floating in that sense for Sukanya Samruddhi as well as for the Public Provident Fund Scheme.
Going by the depositor's mindset, Harsh, a lot of time what people do is they see the rate going up, they get very impressed by it and they lock in their money without even factoring the post-tax return. How important it is to factor all these things, and especially your post-tax return when you're talking about fixed income instruments?
So if you just keep aside the tax advantage, things like Public Provident Fund, where interest is completely exempt, Sukanya Samruddhi, interest is completely exempt. Otherwise, and please remember, in both of them, your money is locked in for very long periods. But if you look at, say, the 3-year time deposits or bank fixed deposits, your interest rate is locked. So suppose you see, okay, rates have risen, so let me lock it in for 5 years. Now your rate is not going to change. Every year, and whatever interest is getting accrued, even though it is not paid, you will have to pay tax on it. A very good alternative, an equally safe alternative, but which is much more tax friendly, would be what I had mentioned before, some sort of a target maturity fund. And the Bharat bond that I mentioned is not the only offering, it is the most popular offering in that area. There are many more such offerings that are available. You should talk to your advisor about that. The advantage there is that the interest gets cumulated and your NAV goes up. And when you withdraw after 5 years or 7 years, whenever the fund matures, the rate applicable will be 20%, plus you will get the benefit of indexation if it is more than 3 years. So it can be very beneficial.
About borrowers now, how will it impact your EMI?
So I think what's good for the depositors is not so great for the borrowers.
Right.
So obviously, again, but what happens is, although it impacts in the case of, let's take home loans, almost 100% of home loans are written on a floating rate or what is called a variable rate home loan, which are effectively linked to repo. It does not psychologically affect the home loan borrowers simply because in most cases, in 95-98% plus cases, the lenders will increase the tenure rather than increase the EMI. So as far as your monthly budget is concerned, the same EMI is hitting it. except that now you will have to pay it for far longer. As somebody was just joking that I will have to stay alive for far longer to be able to pay back my loan. What happens is though, so therefore that rate increase does not affect the borrower only in that limited sense on a home loan. Car loans and personal loans are mostly fixed rate loans, and therefore again it does not affect existing borrowers. In the case of people looking now to borrow, whether it is, a home loan or a car loan, the rates go up, whether it is fixed or floating. For a home loan person or even for a car or a personal loan, the eligibility now comes down. For the same level of income, for the same tenure of loan, the EMI now goes up. And since the loan eligibility is calculated by making sure that the EMI is a certain percentage of your income, because the EMI goes up, the amount of loan will come down. The amount of loan that a new borrower will be able to get comes down.
Good time to shift your loan portfolio?
Sorry, I didn't get the question.
Is it the time to shift your home loan? If at all you're getting a better rate somewhere, should one really start asking for it or checking the other banks for options?
You should always, every time is a good time to shift your home loan if you are able to get a better rate from some other bank. Please remember, what you are shifting from is a floating rate loan. You are shifting to another floating rate loan. As long as you are getting a better deal, it will, the spread, as long as it is lower, you are much better off. It needs to be a certain percentage. I would say that depending on the size of the loan, I would say that you would need at least 0.5% or 0.25% difference between the new lender and the old lender before it makes sense to shift. And the best thing is to first try and get your existing lender to reduce the rates. And that typically happens if you are a good borrower, you paid it on time, and your existing lender is giving reduced rates to new borrowers. If you then ask, in many cases we have seen that if you ask and you have been a good borrower, you will also get the reduced rates that are available to the new borrower.
So now in the end, from a person who has a loan portfolio, also has a financial portfolio, wants to look into parking money in fixed income instruments, they are getting a benefit of the raised interest rates, Harsh. Also, they are seeing a longer tenure in their loan repayment. What would be your tips to actually have a portfolio that will earn you all this that you're trying to save and invest, and at the cost of your budget or your routinely expenses? How does one make the most of its of this particular scenario? What should be the real return that you're getting out of this?
So if I have understood this right, what you said is that a person on one hand has borrowed and taken a loan, and on the other side he has invested in a fixed income instrument, right? Rarely will any fixed income investment be able to give you a post-tax return that is higher than the post-tax cost of a loan. And, I would advise that, unless you are a financial expert, I would advise you not to try this. You first pay in a high interest rate scenario if you have money spare, which you don't want to invest in equity. We are assuming that this money is not meant for equity. Because doing that allocation is extremely important, and that is not dependent on, it cannot be dependent on interest rate. It's dependent on many other factors. If that money is not earmarked for equity, if it is earmarked for fixed income, then a great use for that would be to pay off the loan, unless you need the liquidity for something. So it is always best, if it is permanent liquidity, to pay off the loan rather than invest it in a fixed income instrument.
All right, so these are the tips and tricks from Harsh Roongta to make the most of the current scenario where we are seeing interest rate hikes for a depositor and for a borrower. Thank you so much, Harsh, for being on the show.